Hello, everyone. Well, we made it to Friday, so congratulations. Got to take the little victories where you can get them. So yeah, we're going to be talking about chapter 3 today and also doing the first homework. Did want to talk about a few things that came up. So first of all, I know some people have been struggling with different issues or IDEA. Please reach out to me if you have any problems with that. Just as a reminder, if you're doing IDEA, for the most part, you should be able to do that through the Truman State system. It is loaded there. There's this course, assuming that it works for you on the Truman State system, which a few people have run into problems with that. I'm trying to be as flexible as possible in that regard. I have actually reached out to IT support to try to get some answers. I've not heard responses back. I'm sure they're probably really busy right now, but if you're having issues with that, just reach out to me and we'll try to work some details out. So if you're planning on downloading the program onto your own computer, you can usually just click the link through the invitation. There's an invitation link that's in the syllabus, and you should be able to access that. I think I've updated the link. It's possible that I missed something, but you should be able to access and download and be able to get access to the version that you need. But all of those will work reasonably well. At least they should. Again, there's some issues that are kind of I've not been able to address, but I'm working on them as much as possible. Also, I want to make a note about Connect Access. So, First Day Complete. Some of you were in my AIS class last fall for First Day Complete. The fiasco that was First Day Complete, and as I called it. I don't know that I haven't had anybody tell me that there's some issues with accessing Connect this semester through First Day Complete, at least not in this course. But I'm definitely having problems in AIS, and so. If you go to Connect, if you are accessing, you've got an account in Connect and you see an assignment there, you don't need to worry about that. I just did that, so there's an easy way to link to to Connect through Brightspace. There is a Connect access link that you should be able to use. It is not required if you can access Connect manually. It's just something I wanted to bring up. So don't panic if you see an assignment in Brightspace and you're worried about what I'm doing. It's just mostly just a protocol that I have to run through because our Brightspace is weird. And then kind of as a reminder, this will come up probably as a reminder tomorrow sometime, but we do have our first discussion on Monday. Again, the discussions do not have a deliverable associated with them, but you are expected to complete them. Basically, you'll just go through the questions, prepare answers, and then when we discuss them in class, you'll have answers to discuss. And they may or may not align with mine, but that's the whole joy of learning is that you get to learn what you know and what you don't know. Both of those are possibilities. Today, we're going to have our first homework assignment, but we need to start out with a discussion of the first part of chapter 3, which is going to be client acceptance and then audit planning. So as we're going to talk about over the course of the semester, auditors are business people. We don't just do audit because we're told to do audit. We are trying to sell our services. This is a really, really weird opportunity because our services are basically trying to find problems with the client. So clients have to hire us, but they don't necessarily want to hire us. We do provide value in that, or in the regard that we improve the quality of decision making and the quality of information. But it's one of those things that's just kind of weird. If you were to ask somebody, I'm going to hire you to come in and criticize me and insult me, you probably wouldn't want to do that. At least that's not the goal. I suppose to some degree, that's what my job is in here, not to insult you. I would never do such a thing. But I will definitely criticize you through the grades and the exam. So I guess you can argue that I'm an auditor in that regard. But it's in traditional work. Like you don't walk over to the grocery store and have say somebody try to buy a service for somebody. It says, "Hey, can you tell me what I'm doing wrong?" And somebody at Walmart's not going to tell you, "Well, I really don't like those shoes." So it's a weird business, but it is a business nonetheless. And so we have to understand that the decisions we're going to make are going to align with the kind of decisions that we make as a business. So the very first thing we need to talk about is, when do we start business with a client? How do we make that decision? So there's a few different approaches. There's whether we're starting business for the first time or whether we're continuing on with business over a long duration. We're going to talk about the first one, and this is going to be multifaceted because there's a couple of possibilities. There's a possibility that we're going to be the auditor for the client for the very first time in their career. This is the first time that they've had an auditor, very first time their books have been audited. There's also the possibility that they've been audited before, but we were replacing an existing auditor. How do we determine if we are going to take that role, that responsibility on? So before accepting a new audit client, an accounting firm must determine that it first and foremost, is capable of performing the engagement. If you are hired to do a job, you want to make sure you don't do the job. Or you can do the job. This is not one of those situations where you can walk in and just try to get on the job experience. They're going to expect that you have knowledge and capacity to do what you need to do. Also, that you comply with legal and relevant ethical requirements. So as we're going to talk about, there are certain criteria that we have to follow, both from the perspective of the audit, and the perspective of the client as well. There's going to be a lot of different rules that we have to be aware of. The rules of the audit were going to be kind of second nature to us once we move through this course. We're going to talk about the standards. We're going to talk about the criteria we have to follow. We're especially going to talk about our independence. But there's also the client criteria about what the rules they have to follow. And we have to be cognizant of all of those. So as we go through this, we're going to be talking about auditing standards, which are separate from accounting standards. Is everybody excited about that? You get to learn a whole new set of standards other than GAAP. Yeah. Or you could just be like, I don't want to learn anything ever again, Dr. Barnes. I'm really, really tired. That's why I'm a senior. So it's going to be a contingent on a couple of things, but for the most part, we have to be cognizant and knowledgeable about all the standards that we have to follow in there. And then we have to consider the integrity of the client. Generally speaking, you're not going to ever find a client without fault. You're never going to find the perfect client. But you do need to want to make sure that management is not deliberately misleading you about their position, their status. If we are trying to make sure that management's attestations make sense, that the assertions that they make are easy enough to follow, and that we can determine they're accurate or not, we want to make sure that they're not lying to us as well as all the shareholders. Now, we do have a responsibility to some degree to find out if management is lying, but if we know upfront the management is not being forthright and the client is just completely and totally lying to us, it's probably not worth our while to engage with them. Let's talk about a couple of things that are a few things that were with respect to auditors or clients who've been previously audited. So when the prospective client has been audited, the successor auditor will make inquiries of the predecessor auditor before accepting the engagement. So we are taking on the new client. We are the successor auditor. The predecessor auditor was the person or the entity who audited the client previously. What are some things that we want to talk to that individual or that entity about? Well, the first thing, management integrity. We just talked about the reason why for that just previously. Also, disagreements with management. This is not saying that management is dishonest, but they have a different interpretation of the way the financial statement should look with respect to their presentation and their preparation than the auditor believed. This can be honest contention, but it may be difficult for us to come to a conclusion with the client if we are going to be constantly disagreeing with what they're doing. Communications with corporate governance. We talked about corporate governance in the last lecture. We said that's going to be the board of directors or the audit committee, which we're going to get into detail about the audit committee here in just a little bit. We also want to know the reason for the change in auditor. Why did they decide that they needed to have a new auditor? Why did the previous auditor leave? And that may be something you may consider that to be nefarious, and it has been in the past. There was a issue with a company called Overstock.com about 15 years ago, where they turned over auditors about 5 times within the course of a few months because they could not find an auditor who was willing to do their nefarious bidding. That's one of the nightmare scenarios. But usually this is for more innocent purposes. A good example of this would be Amazon. Okay, has everybody heard of Amazon? My company, this small startup that sells textbooks. That actually was true 20 something years ago. In fact, I remember buying textbooks from Amazon when I was at college. I said, this is cool. This is nice to have an online resource where I can buy textbooks. I wonder if this company is going to be in business 20 years from now. A little while later, I'm buying everything from Amazon. So there you go. So they've grown pretty substantially over a very short period of time. And that means that they probably have changed the auditors that are going to be working for them. Back when they were just a textbook reseller, online textbook reseller, they probably could use a regional auditor without too much trouble. Now they're one of the largest companies on the planet. So they probably are going to employ a Big Four. In fact, I think I should know who the Big Four company is. I looked it up once, but I've forgotten because I've slept since then. So we want to know the reason for the change in auditors. Sometimes that reason is going to be fairly straightforward. We also want to know about related parties and unusual transactions. We're going to talk about the nature of related parties in just a bit, but usually that's going to be something that needs to be disclosed. And we also want to know anything that's out of the ordinary that comes up with respect to the client operations. All right. So these are for brand new clients, whether they've been audited or not. These are some questions we have to be asking. What about if we are the previous auditor? Are we going to continue on with the current client? I will say about 99 times out of 100, the answer to that question will be yes. All right. It's very, very hard to find new clients, and we are a business. We have to generate a profit. If we just do one client and say, that audit was hard, I don't really want to do it again, then it's probably not a good business model for us to be involved in. So that's going to be our next question is, what are we going to do with respect to client continuance? So the first thing is we're going to evaluate client retention periodically. You can kind of usually in this course think about this as an annual thing that will happen. It will happen at least annually, though it can occur more frequently, particularly if we're talking about a significant event happening. So as we complete the annual audit, then we're going to say, is this an audit we want to continue for the foreseeable future? If the answer is yes, we're going to move forward. If the answer is no, then we cut it off there. But what about if there's a big significant event, like say, for example, an acquisition or a merger? Would that be something we'd want to continue on with? Well, for a regional company, we may not have the capacity to do an audit of a new larger company if an acquisition took place. So we may want to make the decision, we are going to turn this over to another audit firm or another accounting firm. So those are going to be examples of when we would make a decision not to continue on after a significant event. What are some things that we need to consider as part of that decision of whether to continue on? Well, there are generally going to be two reasons why we as auditors will say we do not want to continue on with the client outside of really unusual circumstances like mergers and acquisitions, something like that. There are going to be two reasons why this process does not continue. The first of these, if there are conflicts over accounting and auditing issues. We talked about that earlier, disagreements with management. If management has one vision, a way that the accounting should work, and we as auditors say we have a different perspective, that doesn't mean either group is right or wrong, but it means that they can't really come to an agreement easily. And that is really a problem because we are going to often reach the conclusion that the financial statements are wrong. So that's something that's going to be problematic. So if we have frequent conflicts with management, we may not be the best fit for this particular company. The other one is going to be disputes over fees. And it seems like such a small issue. It seems like that seems so petty. Okay, so petty. It's like, well, we want to be paid more. Well, let's be honest. If we're not paid enough, can we really do our job effectively? So what is going to be the scale for which we operate? There's going to be two things that determine our pay. There's going to be the rate at which we operate, and there's also going to be the number of hours. So if we're getting paid less, either we have to charge a lower rate, which is not going to work because we still have to pay our people. We still have to pay them amount of money, or we have to reduce the number of hours that we are charging, which if we reduce the number of hours, what does that mean about the audit? It's probably, so that heard somebody say something. It's going to be worse. It's going to be worse. Yeah, basically that's what it is. They say, yeah, it's basically going to be less effective because we're not going to do all the work that we need to do for that. Yeah. So that's basically where we're at, is that we have to make a decision. And if we have a dispute over fees, it often may times lead to the point it's not worth it for us to do the job anymore. All right. Let's go ahead and let's talk about preliminary engagement activities. And obviously, I'm talking about audit engagements. I think I preempted myself because I got a really bad joke in the next slide that nobody ever laughs at. Anyway, determining the engagement team requirements. So we need to know how many people we need on the engagement team and what roles they're going to fill. So this is going to be at all levels. How many audit staff do we need? How many seniors? How many managers? And what partners do we need? For really large clients, we're going to definitely need more individuals, possibly with specialized talents in that regard. We also want to ensure compliance with ethical and independence requirements. Now, the actual specific requirements in this area, we're going to get to much later in the course, but for right now, we do need to note that compliance with these rules are really important. We have to make sure that there is no existing interest. Let's talk about an example of this, okay? Something that's kind of fun, all right? So let's say that I have a client that I did an audit for in the previous year, and they still have not paid me for those services. So now their fees are 300, we'll say 366 days past due. All right. Can I still do the audit for them? It's like, well, I don't know, Dr. Barnes. 366 seems like an awfully specific number. What's the relevance of 366? It's more than a year. Okay. What happens from a financial accounting perspective when you have something, a payable that's past a year? Can you? It becomes imputed interest becomes a long-term payable. Becomes a long-term payable. If it's a long-term payable, there's implicit interest associated with it. Whether or not there's actual interest, you have to calculate it implicitly. Remember that from 303, implicit interest. When you have a long-term payable, you are a creditor. Okay, if you're a creditor, you have an interest in the organization, which means that you're auditing somebody you effectively own. Does that seem to be a violation of independence? It is. It's a big violation of independence. So that's why 366 is really important. So anything over a year past due, that's kind of an example of where we'd have a violation of that. We also need to establish an understanding with the entity, and we're going to do that through multiple different ways. We're going to do it through the engagement letter, the work of the internal audit function, and the role of the audit committee. All right. So here's where the bad pun comes in. So the engagement letter, obviously, I'm talking about this type of engagement. Okay. No, obviously, I'm talking about a different type of engagement. There was some sympathy chuckles. Thank you very much for that. I really appreciate it. Okay. At least I didn't get any rapid head shaking for that particular bad joke. So an engagement letter is actually on pages 71 through 73 in the book. At least I think those are the pages. I think I've updated that. Basically, all this is this is a contract with the client, or more specifically, on page 71, it says this letter serves as a contract outlining the responsibilities of both parties. Now, if you read through 3 pages of the book and you read this engagement letter, it is a little bit dry and a little bit tedious, as many things in this course can be at times. But there are 3 things that we need to know that always have to be present in an engagement letter. So this is the point where you're going to want to take notes, because this is not in the slides, but it's definitely something I will test you on. Okay. So what are 3 points of the engagement letter that are always present? Three parts of the engagement letter are always present. The first one is pretty straightforward. What is the objective of the audit? What is the objective of the audit? The second one is going to be outlining management's responsibilities. So what's management's responsibilities? And the third one is outlining the auditor's responsibilities. Third is outlining the auditor's responsibilities. Now, let's just break that down. We're going to talk about this next point a lot over the course, but I want to introduce this right now. Are management responsibilities and auditor's responsibilities the same? No. Who's responsible for preparation and presentation of the financial statements? Management. Who's responsible for the development, implementation, and maintenance of internal control? Management. Okay. They're responsible for creating these things that are related to reporting in the organization. They make the financial statements, they create the controls, they ensure a proper operation. What do we as auditors do? We come in and evaluate those things. We evaluate the financial statements, we evaluate the internal controls. Now, we're going to get a little bit more specific of that, but right now, that's all you need to remember, is that management is responsible for creating those things, auditors responsible for evaluating those things. That's the big distinction that we have to make right there. All right, now we have this thing called the internal audit function. I made a little discussion about that on Wednesday. I said the internal audit function is a little bit different from the external auditors. We as external auditors, we don't work for the company. We are hired by the company to do a job, a job that is going to be limited in scope and function. The internal audit function, that's people who actually are employed by our client, and they usually work there year round in entire periods. So they have a large area of responsibilities, which we're not going to get into a lot of depth right now. We're going to talk more about those when we get to get to the preparation for the second exam. That'll be kind of a thing that we'll discuss at the end of chapter 21. But these are people who basically do a job somewhat similar to us. They provide assurance with respect to information that's prepared by the client, or to operations that are done by the client. And so they're doing tasks very similar. Now, let's just ask a very simple, basically a rhetorical question, okay? Because I expect everybody to get this answer correct. If I want to determine who has more expertise and knowledge about the client, is that going to be the internal audit function, who works for the client on a daily basis, or the external auditor, who only does work on a short period of time? Internal auditor, yeah, obviously. So would it make sense for us as external auditors to leverage the skills and experience of the internal audit function? Yeah, if we can trust the work, then we would definitely want to use their work, because they know a lot more about the operations of the work than we do. This was actually a big point back in 2005. I know that's many, many years ago, but back after the Sarbanes-Oxley Act was passed and the PCAOB started, there was a standard called PCAOB Auditing Standard Number 2, which made CEOs and CFOs very, very angry, because basically it said that the audit team had to do all of the controls testing. They cannot rely on the work of the clients. They cannot rely on the work of the internal audit function. Then Auditing Standard 5 came along and said, okay, we were just kidding. You guys can go ahead and rely on the work of the internal audit function. But in order to rely on the work of the internal audit function, we must test 3 characteristics, okay? 3 characteristics. First of all, we need to know the extent to which the internal audit function's organizational status and relevant policies and procedures support the objectivity of the internal auditors. So objectivity is bolded and italicized, so that's obviously an important term. Are they objective? Are they free from compromise from the management? Secondly, we need to evaluate the level of competence of the internal audit function. Are they knowledgeable about their job? Can we trust the work that they're doing? Because do they know what they're doing, basically? And the third one is the application of a systematic and disciplined approach, including quality control. Systematic and disciplined approach, does what they're doing make sense? Can we follow it? Now, in your homework, you're going to notice that two of these terms are going to pop up on one of the questions. The third one is conspicuously absent. For our purposes, we're just going to consider all three jointly, but depending on the standards that we're looking at, whether this be Auditing Standards Board, ASB, or Public Company Accounting Oversight Board, PCAOB, either two of these standards are going to be applicable or three. For our purposes, we're going to consider all three, but there is a homework question that only talks about two of them. For the exam, I expect you to know all three. Okay, I want to make sure that we're clear on that. All right, so this is a little bit of a breakdown, a little bit easier thing to note. Just make sure you remember those three concepts, and everything should be fine for there. So let's talk about this thing called the audit committee. Okay. Now there's a couple things that we need to discuss with respect to the audit committee that are really important, and then we're going to break down a little bit more definitionally. So first of all, this is a subcommittee of the board of directors. Now we know that the board of directors are representatives of all shareholders in the organization, and they basically are there to kind of provide oversight of management operations. So board of directors are a small group that are basically tasked by the other shareholders to represent the interest of the shareholders. This is a smaller group of that same board of directors that provides interest with respect to audit function. Now, I want to make this one quickly noted because this is really important. With respect to privately held companies with those non-issuers, there are no criteria on how privately held companies' audit committees are constructed, okay? Anybody basically can be on the audit committee. I think the only requirement is they have to be a subset of the board of directors, which means they have to have shares in the organization. There's no specific criteria. But what have I said multiple times already in this course about which area we're focused on? Are we focused on privately held companies? No, we were going to focus on public companies, which means we need to know some information about publicly traded companies. Now, this actually is really an important point because I think I'm about to make everybody's day. It's going to be a great Friday, all right? So there was this act that was written back in 2002 that we've talked about. It's noted as SOX. Okay, what is that called? Sarbanes-Oxley Act. How many of you own a copy of the Sarbanes-Oxley Act? Well, if you don't own a copy, I have made your day because I have uploaded a copy to Brightspace that you can download for your own purposes. So now you can never say you don't have a copy of the Sarbanes-Oxley Act, all right? As every good accountant should have a copy, you now have a copy. Now, I'm not going to test you specifically on every part of the Sarbanes-Oxley Act, but there are a couple of that I think that are very important. Actually, more than a couple, but a couple for today. The first one is SOX 301, SOX Section 301. Details specific requirements and responsibilities for audit committee members of publicly traded companies. Now, there's a lot more to it than this, but it effectively boils down to the following words. The audit committee must be composed of outside independent board members. Outside independent board members. Now, this term independence is a little bit confusing because obviously if you own shares in an organization, then you can't really be truly independent, at least not from an audit perspective. But independent here is outside independent here basically means something different than what we mean it from the audit perspective. So outside is pretty straightforward. If we're outside, we're people who can't work for the organization. In other words, management of an organization cannot serve on an audit committee. Okay, management of an organization cannot serve on an audit committee, at least not a publicly traded company. Management of a publicly traded company cannot serve on an audit committee. Independent is a little bit more subtle and distinct in this regard. Independent basically means that they cannot accept compensation outside of what they already receive on the board of directors. So basically, outside means can't be a manager. Independent means can't be additionally compensated. That's really all there is to it. Additionally, SOX Section 407 requires that at least one member of the audit committee be a financial expert, So on the audit committee, we need to have somebody who knows at least something about auditing. I think that's probably reasonable to make sense that somebody have auditing. So only one person, but it does have to be at least one individual. So how's financial expert defined? That would be somebody who has served in a fiduciary role for an organization during a period of an audit. Generally speaking, this is somebody who's been a CFO or a controller for a publicly traded company. So according to that definition, Even though we're all working hard at becoming financial experts, none of us would currently qualify in that because I've never been a controller or a CFO. All right. So I would not qualify to be the financial expert in the organization, which seems kind of counterintuitive, doesn't it? Yeah. We believe in your expertise, Dr. Barnes. Thank you. Thank you. All right. So, yeah, that's going to be the criteria for with respect to the audit committee composition in an organization. All right. So let's talk about audit strategy and planning. So audit strategy is what helps the auditor determine what resources are needed to perform the engagement. Then a little bit more detailed is the plans. More detailed in the audit strategy considers how to conduct the audit the engagement in an effective and efficient manner. The way to delineate this is the strategy is kind of an overhead view. It's basically a high level approach to the audit. The plan itself is going to be a more detailed, more granular approach, looking at specific situations within an organization and providing the context once we know the details. So what are some things that we're going to have to consider? Well, there are a lot of them, all right? So on this next slide, don't panic. I would tell you very heavily to focus on the things that are in the slide, but most importantly, focus on the things that I either give you notes about or that are italicized and bolded. All right, so what are some steps in planning? Assess the business risk. This one is not really important to know right now, simply because we're going to spend an entire chapter in chapter 4 talking about the nature of risk, but it's really important to note that this is obviously part of the plan. Establish materiality. We can ignore that for the time being because we're going to focus on our entire next lecture, or at least the part that's not part of the discussion, on the concept of materiality. We also consider multi-locations. This is mostly important for publicly traded companies, as many of them operate in different jurisdictions. So we need to understand, how do we audit over multiple jurisdictions? We also need to assess the need for specialists. This is pretty obvious. If we got a client that's operating in an area of business that we don't have expertise, we better get some expertise. We better have somebody who's knowledgeable about that. Is anybody in this room knowledgeable about oil and gas accounting? I don't know why I'm raising my hand. I'm not either. I audited multiple oil and gas companies, but I'm definitely not an oil and gas expert. And nobody should be. It's crazy. It's just the most ridiculous form of accounting you've ever seen. Making accruals and then reversals of accruals and vice versa. Yeah. Consider violations of laws and regulations. Obviously, this is really important for continuation and a client acceptance, but it's also really important for the negotiation of audit, particularly if we're in an area that there's a lot of contentiousness about the laws and regulations. If it's a highly regulated industry, this is really, really important, even though it's an operational concern. Identify related parties. We're going to talk about that in just a second. Consider additional value-added services. All right. So this is basically independence versus expertise. There's a kind of a trade-off there. If we have expertise as an auditor, then we may be able to provide additional services to the client. That being said, we can't do anything that would violate the rules in that area. And those are very strict according to the Sarbanes-Oxley Act. Generally, if you provide assurance services through audit, you can't provide additional non-audit services. And then finally, document the overall audit strategy, audit plan, and prepare the audit program. So we're going to get a lot more into documentation in chapter 5. You will have some exposure to that for homework as we do some basic stuff, but the more detailed stuff we'll get in chapter 5. I do want to jump back to the violations of laws and regulations. So if we identify illegal acts, what is the auditor's responsibility? So first of all, do we think auditors probably have a responsibility for client conducting illegal acts? It would make sense. It would make sense that they have some responsibility, but not a responsibility to identify every illegal act. Like if the client is conducting a massive multi-million-dollar fraud, then yes, we probably have a responsibility for detecting and correcting that. What if the client stole a stick of gum? Probably not so much. Probably not so much. So an auditor has responsibility to plan the audit and provide reasonable assurance of detecting illegal acts that have a direct and material effect on the financial statements. So I read through that first part very quickly. The last part was really important. We have to detect illegal acts that have a direct and material effect on the financial statements. So if it's not material or if it's not direct, then we're not responsible for identifying that over the course of the audit. Now note, this is just saying that the auditor has to plan the audit procedures to make sure that we detect and identify any direct and material effects of illegal acts. Doesn't mean that we have to capture those necessarily. If we fail to capture an audit, but it was obvious that we would never have captured that through the nature of reasonable audit procedures, then we are kind of off the hook. On the other hand, if we fail to do so, and it's obvious that we should have captured those direct and material or those illegal acts, then we're in trouble. So what's a related party? What's a related party? So there's pretty obvious relationships. We could actually talk about familial relationships. If you got somebody who's in your immediate family that you're doing business with, that's a related party. Related parties can also be a little bit more subtle. You can actually have business partners, people you've done business with outside of the scope of the particular engagement. Basically, a related party is anybody who's in a position to gain undue influence or undue advantage. All right. So related party transactions may not be at arm's length. Have you heard that term at arm's length before? Some of you, I see some nods, some of you don't see anything, so I'm assuming that's a no. But let's talk about the nature of arm's length transaction. Let's say that you are engaging in a party that you've never done business with before. You're just meeting for the first time. You consolidate the contract, or you basically conclude it, and you say, "Let's do business together." How are you going to finalize that agreement? What's the common way in the United States to do that? Shake your hand. Okay. Well, contract, yeah, that's the legally binding one, but you're going to shake somebody's hand, right? Can we say that that's at arm's length? That's by definition at arm's length. You're reaching your arm out to shake somebody's hand, okay? If you do business, let's say with your father, okay, or your parent, your one of your parents or your spouse, okay? Say, let's do business together. Are you going to shake their hand to confirm the agreement? You're probably going to be closer than arm's length. You probably say, "Give me a hug. Come on, get in there." Yeah. So that's going to be an example of something that's not at arm's length. It's a closer relationship than arm's length. That's something we have to be very concerned about. Now, I want to make a note of this. This is something you should have known from financial accounting, but it's going to come up and it's be very important in this course. Management of an organization is required to disclose all related party transactions and the nature of those transactions. This is a FASB reporting requirement. This is under generally accepted accounting principles. If you engage in related party transactions, you have to disclose those in the financial statements. Okay. So that leads to the question of what is audit responsibility? So you do need to know that first part, but this is something you should have known from previous courses. If you didn't know it, now you do. So GAAP says required disclosure of all related party transactions. Auditors, we have a responsibility to obtain an understanding of these relationships and transactions, and we want to make sure that all transactions have been properly evaluated and disclosed. Been properly evaluated and disclosed. That is not, you notice up here, this is not saying the auditors have to make sure that no related party transactions take place. That did not say that, okay? Related party transactions do take place. They can and do take place fairly frequently. We are just trying to make sure that all necessary transparency surrounding these transactions is proper, okay, that is in place. All right, so let's go ahead. Let's talk about where we're moving from here. So we're going to wrap up chapter 3 on Monday, and then we're going to move into chapter 4 on Wednesday, where we're going to talk about risk assessment. Then we're going to move into chapter 5 and substantive procedures, and we're going to talk about analytical procedures and tested details. We're going to have an exam to celebrate, and then we're going to talk about internal controls in chapter 6 and chapter 7. These are going to be the focus of those chapters, and there's a reason that they kind of are put up here, is because these are sequential parts of an audit process. We are at the point right now where we're preparing the planning phase. We're developing the plan for the audit. What is our next step? Our next step is to say, let's assess the risk associated with this audit. That's going to be our risk assessment step. After that, once we've determined what the risks are, we can design our procedures to address those risks. There are two areas that we're going to be concerned about. We're going to be concerned about what controls does the client have in place. Everybody remember controls from AIS? I'm trying to forget, Dr. Barnes. Thanks for reminding me. Yeah, remember the controls from back in AIS? We're going to talk about how the auditor evaluates controls. Once we've assessed controls, we're going to say what other work needs to be done. And that's going to be our substantive procedures. Now, overall, this is generally going to be a sequential process, okay? In general, it's a sequential process. The reason why is because information from planning gives us detail about what we need to do for risk assessment. After that, once we have achieved risk assessment, we can make decisions about what we need to do for test of controls. And once we finalize test of controls, it gives us information about substantive analytical procedures. Now, that may seem like I'm just kind of rambling right now, but that's going to be a really important concept that we're going to ingrain in our discussion of chapter 4 when we get to risk assessment. And we'll see why. We're going to see a big mathematical equation that doesn't use any numbers, but we're going to have to understand that equation, what it represents with respect to this sequence, okay? But the sequence is important. That being said, there are times that we can jump the sequence. We can do things out of order. Sometimes we can do test of controls and substantive procedures jointly. These are called dual purpose tests, and they give us assurance in both areas. Assurance is to show what the situation with controls is and what the situation with substantive procedures are. Now, I will tell you it's not necessarily the same test, it's just tests that we're conducting at the same time because we're looking at the same area. Generally speaking, test of controls and substantive procedures are separate in what they're trying to look at. But that's neither here nor there. We don't need to get into too much detail now. For now, we can call it good for chapter 3 and get on to our chapter 1 and 2 homework. All right. We got 15 minutes to go through these. I think we should be okay, but let's go ahead and get started. An independent audit adds value to the communication of financial information because the audit does what? Well, let's go ahead and read answer A and talk about why it's wrong. Confirms the exact accuracy of management's financial representations. What do we got?
Well, nothing, but they don't do it like exact accuracy. But basically it doesn't ensure like exact accuracy.
Yes.
Reasonable assurance.
Exactly. That's the term we're looking for, reasonable assurance. Anything that makes an absolute statement, okay, you want to avoid. This is just general good life advice, but certainly going to be applicable in this course. If we see something with an absolute statement, we want to be very wary of that. I'm not going to say it's never correct, but it's very rarely correct. And if you look at all the answers, those are all of those things that they have absolute statements. So C says guarantees, which is an absolute statement, and assures the readers that any fraudulent activity has been corrected. So we identified all fraudulent activity. We're not trying to provide any guarantee. We're not providing any absolute assurance. We're providing reasonable assurance that the financial statements are free of material misstatements. So that's a credibility exercise, adding credibility to that. All right. 14, which of the following best describes the reason why the independent auditors often retain to report on the financial statements? Okay, so I'm going to read through these and see what we got. Management fraud may exist, but is more likely to be detected by independent auditors than by internal auditors. It's really hard for me to read. I'm getting old. All right. So is that true? Is that going to be detected by independent auditors and internal auditors? No, we already talked about the independent auditors are generally going to be much better off than internal auditors, and the internal auditors will be better at their job at understanding of the client than the independent auditors. Man, I'm really struggling with that. External auditors generally have a limited view of what the operations of the organization are, so we can't rely on A. Different interest may exist between the entity preparing the statements and persons using the statements, thus outside assurance is needed to enhance the credibility of statements. That sure sounds like the principal agent discussion we had on Wednesday, doesn't it? That's why B is our answer, but let's look at the rest. Misstatement of account balance may exist, but all misstatements are generally corrected the result of the independent auditor's work. That would be wonderful if that was the case, but that's not realistic. Entity may have poorly designed internal control system. That would be one reason why we want to report, but it's not on financial statements that relates to controls. 115, which of the following best describes relationships among auditing, attest, and assurance services? So those are those three ovals. What's the outside oval? Assurance. The middle oval is station, in the middle or the center oval is auditing. Okay, so which one of those represent? Auditing is a type of assurance service. Yes. Okay. This is how long I've been teaching the course. I find this next one funny. Okay, which of the following statements best describe how materiality relates to audit evidence in a financial statement audit? So A says materiality refers to the material from which the audit evidence is developed. I think Dr. Achero would love that. Materials, labor, and overhead. So. No, that's not the answer that we're looking for right there. So it's either going to be B or C. The question is, which one is it? Okay, which one is it? So the higher level, which auditor assess materiality, or the lower level auditor assess materiality? It's going to be the lower the level which the auditor assesses materiality, the greater amount the evidence the auditor must gather. All right. Now, that's always confusing, so let's discuss why. All right. Let's say that I'm auditing Greek corner euros, and I say to myself, what type of misstatement are they going to be most concerned about? And I say $1 million misstatement. The amount of work I have to do is going to be minimized because they will accept anything up to $1 million of a misstatement and say that's fine. But let's be more realistic. I go there and I say they'd barely make any money at all. They probably would be freaking out if it was a misstatement of $10,000. So I have to find all misstatements that are going to relate to $10,000 or more, or at least any aggregate misstatements of $10,000 or more. Now you have a task, okay? You have to find any misstatements that are over $10,000 or any misstatements that are over $1 million, which is going to be the easier task. Which one you have to collect more or less evidence on? The $1 million misstatement. Those are much larger and easier to identify. So if you have to identify smaller misstatements, that's a lot more work. That's a lot more work, which is why we say the lower level of materiality requires more evidence. By the way, if you don't understand that, make sure you review what I just talked about and why that's the case. If you're still struggling, come talk to me. This is an important concept for this course. If you don't understand the relationship between evidence and materiality, it will get really confusing moving forward, especially when we start working on Monday. So more work for lower materiality, less work for higher materiality. All right, 121. Which of the following statements best describe what is meant by an unqualified audit opinion? Well, I do like the answer B that says an unqualified audit opinion indicates the auditor is not qualified to express an opinion. Okay, that's not the answer. I appreciate somebody laughed with me because I still find that funny, and everybody's like, "That's not all that funny, Dr. Barnes." Yeah, you will find it funny once you're done with this course. But unqualified opinion, what did we say about an unqualified opinion? Is that a good thing or a bad thing? It's a good thing. It means there's no qualifications necessary. So an unqualified auditor's opinion indicates the auditor's opinion on the client's financial statements are fairly presented in accordance with agreed upon criteria with the inclusion of no qualifying phrases. Okay. So D is our answer. By the way, there's that word, those words agreed upon criteria. For publicly traded companies, they have one set of agreed upon criteria that you should be pretty familiar with by now. Does anybody know what I'm talking about? So that's those are auditing standards. Okay. Yeah, I like the way you're thinking because of this PCOB, but you're not quite familiar with those yet because I haven't really taught you any of those yet. But there's one set of criteria, another set of reporting criteria that you should have had multiple classes on. Give you a hint. It's also the name of, yep, there we go. I was going to say the name of a store at the mall. Yeah, yeah. It's an old audit partners joke. So I bought these pants at the Gap. GAAP. Never mind. Never mind. All right. All right. So 123. Client has used an inappropriate method of accounting for its pension liability on its balance sheet. The resulting misstatement is material with auditors not considered the fact to be pervasive. The auditor is unable to convince the client to alter its accounting treatment. The rest of the financial statements are presented fairly in auditor's opinion. What kind of audit report should the auditor issue under these circumstances? So material, which means it's big, but not pervasive, which doesn't means that it's not really big. So that means that we're at the kind of the middle level of opinion. So what is that middle ground? It's not unqualified, but it's going to be qualified. Okay. Now, question, is this a departure to GAAP or is this a scope limitation? This is a departure from GAAP or a scope limitation? Departure from GAAP. Yeah, they're not following the rules of their reporting criteria. So it's departure from GAAP. If that was the case, let's say this is a pervasive misstatement. Does anybody remember what type of report we'd issue in that situation? Adverse. Very good. Okay. What if it was a pervasive scope limitation? The disclaimer of opinion. Disclaimer of opinion. It's where we do not issue an opinion whatsoever. Okay. Move on over here. Some small questions on chapter 2. 219. Which of the following statements best describes management's and external auditors' respective level of responsibility for public companies' financial statements? Okay. So I'm running out of time, so I'm just going to go to the correct answer. Management has the primary responsibility to show the company's financial statements are prepared in accordance with GAAP, and auditor provides reasonable assurance that the statements are free of material misstatement. Now, there's a couple of things to note here that are really important. The first one is obviously that agreed upon criteria that we talked about earlier. Publicly traded companies will always follow GAAP. Okay, always follow GAAP. Now, you may be saying, what about IFRS, Dr. Barnes? Can they be traded on public exchanges? Yes, but usually IFRS companies have to be audited by a different set of standards. They can't be audited according to PCOB standards. So that can be traded on the US exchanges. They can't be audited under PCOB standards. So second one, this is a really strong depiction of management and auditors' responsibilities. Management's responsible for creation or evaluation of financial statements and internal controls. Creation of those items. Auditors' responsibility for the evaluation of financial statements and internal controls. So that delineation really, really important to distinguish. All right. Again, that's a simplification. We're going to use more nuanced terms a little bit later on, but for right now, management creates the stuff, auditor evaluates the stuff. 221, what is the PCOB? So says a quasi-governmental organization that has legal authority to set auditing standards for audits of public companies. What do you guys think on A? Sounds good to me. I'm happy to stick with A. Let's just stick with A. No need to read further. It's auditing standards. Yeah. PCOB is just auditing standards. Yeah. So accounting standards are going to be this the FASB standards that we talked about before, that's generally accepted accounting principles. Yeah, that's one of the reasons why B is not correct. And so we're just focused on auditing standards, which is a little bit confusing because PCOB stands for Public Company Accounting Oversight Board. You'd say that's accounting standards. It's got accounting in the name. Well, that's where they try to get you. That's where they try to fool you right there. That's where they try to confuse things. All right, moving back. A is correct answer. You were recently hired by the CPA firm Hansen and Hansen. Before you start working, the firm requires that you participate in a first-year staff training course. The audit instructor asks you to prepare answers for the following questions. How is audit evidence defined? Okay, so we talked a little bit about this on Wednesday. We talked about the nature of audit evidence. Audit evidence can be many different forms. It can be records and documents, or it could be tasks performed by the auditor, but they all represent audit evidence. What are they trying to prove with respect to audit evidence? What are they trying to gather information on? Does anybody remember the concepts that we talked about close to the discussion in chapter one? The assertions. There we go. Yeah, the assertions. Yeah, the management assertions. The example that I gave is the assertions were going to be for inventory that it exists and is properly valued. We're going to collect evidence that represents those management assertions. That's the goal here. So our evidence is going to align to those assertions. So that answers part B. How does a collection of evidence relate to management assertions? The answer is so we need to identify appropriate types of evidence to test the certain assertions that we're concerned about. Now, it's important to note, we're not going to get into this now, but we are going to get to this really, really heavily when we start talking about this in chapter 5. Not every single account is relevant to every single assertion. Remember, we had 8 different assertions, and the ones that I identified for inventory, as I said, I'm concerned about existence and valuation allocation accuracy. Existence, occurrence, valuation allocation accuracy. Can other assertions be relevant? Yes, but primarily those are 2 assertions that I'm very concerned about with respect to inventory, mostly because it's an easy example for me to talk about in class, but also because those are 2 relevant concerns. So for existence occurrence, is it possible that you could have a client that says that they've got $1 million of inventory when in fact they have less than $1 million of inventory present? Yeah, there's a couple reasons. One, they could be cooking the books. 2, they could have people who are stealing the inventory and it's no longer there. Inventory is a very high risk area, so that's one way that we could say that inventory does not exist. So we as auditors have to ensure that. We collect evidence to ensure that that inventory exists. All right, last question for the day, last question for the week. What are 2 key characteristics of audit evidence the auditor must consider when evaluating the quality of evidence? All right, so this one's a little bit confusing because there's 2 terms that you probably found. Those 2 terms, one represents quantity of evidence, the other one represents quality, okay? You probably found the term sufficiency and appropriateness of audit evidence, all right? If that was your answer, that's fine. Technically speaking, sufficiency represents the quantity of evidence, and appropriateness represents the quality of evidence. This question is a little bit confusing because it says, what are 2 aspects of quality? So in other words, there's 2 more terms that you need to be looking for that represent appropriateness. So what are the 2 characteristics of appropriateness? What are those that we're looking for? These are actually closely related to concepts that you learned back in financial accounting. Does everybody remember faithful representation and relevance? We're going to be talking about that same concept, except we're going to talk about relevance and reliability. Relevance and reliability. Which if you look at statements on financial accounting concepts, number 8, the hierarchy of faithful representation and relevance, you will notice that reliability is a subset of faithful representation. So, but relevance and reliability, those are pretty obvious as to why this is important. Why are those relevant to audit evidence? Let's talk about relevance, okay? Let's say I ask you to provide evidence to support the existence of inventory, and you go out and you support the existence of fixed assets. Is that information valuable? Yes. Is it relevant to the assertion that I'm testing right there? No. Okay. It does need to be relevant to what it is you're looking at, whether that be the specific account, whether that be specific assertion or otherwise. What about reliable? What about reliability? So this one's a really important one. So I ask you to test the existence of evidence. And so you say, well, I went to talk to management and management assures me that the number they have on their books is exactly accurate. Is that evidence? That is evidence. The question is, how reliable is that evidence? It's like somebody asking me, how much are you worth, Dr. Barnes? And I say, I'm a billionaire. I wish. I wish. Yeah. I'm still working on the first million right now. So yeah. So that's not a reliable statement. That's one thing we're going to talk about with respect to evidence is some types of evidence have more reliability than others. We'll talk about why when we get to chapter 5, but that's something we have to note. If something is not reliable, we need to find evidence or we need to find additional evidence that will make it more reliable. So if they say, I have $1 million in inventory and you ask management about that, guess what you have to do? You have to design another procedure that's going to support that particular assertion. You're going to have to gather additional evidence to corroborate that statement. All right. Have a good weekend. I'll see you all on Monday.
Exactly.